Right now, as we look at the live markets on this Monday, November 24th, SoFi Technologies is trading at exactly $26.89, showing a massive intraday gain of $1.70, which translates to a 6.74% surge in a single session. We are looking at a stock that opened the morning at $25.83 and has not looked back, relentlessly pushing toward the $27 level with a daily high of $26.96. This is not just a standard green day. This is a statement move that is challenging the upper bounds of resistance and forcing the entire market to pay attention. Most investors looking at this chart see a simple momentum play, or perhaps a reaction to broader market sympathies, but the reality is much more aggressive and specific to the internal mechanics of this company. The expectation on the street has long been that SoFi is just another fintech trying to find its footing in a high-rate environment, constantly battling for deposits and fighting off legacy banks. The reality we are witnessing today, however, contradicts that entirely. This price action suggests a fundamental repricing event where the market is finally acknowledging the transition from a speculative growth name to a dominant, profitable banking institution. When you see a stock hold a trend like this from 10 a.m. straight through the lunch hour without a significant pullback, it tells you that the bid is real. The sellers are exhausted, and the institutions are likely chasing the price upward because they are underweight. Let's look closer at the way this trading day has unfolded, because the intraday chart tells a fascinating story of supply and demand. The stock opened strong at $25.83, already signaling intent, but instead of the usual morning fade that plagues so many retail-heavy stocks, SoFi found immediate support. You can see on the chart that dip shortly after the open, that sharp V-shaped recovery around 10:30 a.m., that was the bear trap. Sellers tried to push it down, likely attempting to close the gap or trigger stop losses below 26, but the buyers stepped in with immense force. That rejection of lower prices is what fueled the climb we are seeing now into the 2680s. We are hovering just pennies away from $27, and the consolidation here is incredibly healthy. It is flagging right under a psychological resistance point, which often precedes another breakout leg before the closing bell. The volume accompanying this move is the critical variable. A move of 6% on low volume can be dismissed as noise, but when you see sustained buying pressure like this, it implies that larger funds are accumulating positions. We are likely seeing a mix of net new buying and significant short covering, which we will discuss in depth later. The fact that the stock is holding near the highs of the day, specifically $26.96, rather than fading, indicates that no one wants to go home short this stock. The fear of missing out is shifting from the retail crowd to the portfolio managers who have ignored this name for too long. Now, let's address the elephant in the room, the broader sentiment surrounding SoFi. For years, there was a disconnect between the company's performance and its stock price. They would beat earnings, raise guidance, and the stock would still sell off. That created a massive reservoir of skepticism. But what we are seeing today is the capitulation of that skepticism. The market is a forward-looking mechanism, and right now it is pricing in a future where SoFi is not just surviving, but capturing significant market share from giants like JP Morgan and Bank of America. The narrative is shifting from, will they survive, to, how big can they get? This psychological shift is powerful because it expands the multiple investors are willing to pay. Instead of valuing SoFi like a risky lender, the street is beginning to value it like a high-growth tech platform with the stability of a bank charter. When you see a stock hold a trend like this from 10 a.m. straight through the lunch hour without a significant pullback, it tells you that the bid is real. The sellers are exhausted, and the institutions are likely chasing the price upward because they are underweight. Comment below how many shares of SoFi you currently hold and what your average cost basis is. Are you finally in the green after holding through the volatility of the last few years? While the price action is exciting, we need to talk about the business itself to understand why this is happening. SoFi, or Social Finance, started as a student loan refinancing company, but that is ancient history at this point. They have successfully built a financial super app. The core thesis is the productivity loop. They acquire a member through a low-cost product like a checking account or a credit card, and then cross-sell them into high-margin lending products like personal loans or mortgages. This reduces their customer acquisition cost significantly compared to competitors who have to pay to acquire a customer for every single product. Today's price of $26.89 validates that this flywheel is spinning faster than ever. The integration of their technology platforms, Galileo and Technesis, is likely contributing to this optimism, allowing them to power other fintechs and banks, creating a revenue stream that is less dependent on interest rates and more akin to a software-as-a-service model. However, we must look at the risks and the opposing view. The expectation is that with rates stabilizing, lending will boom, but the reality investors must consider is the credit quality of the consumer. If the economy takes a sudden downturn, personal loans are often the first thing consumers default on. SoFi has maintained high FICO score requirements, aiming for a prime borrower, but no lender is immune to a systemic recession. The stock is up over 6% today, which is fantastic, but vertical moves often invite profit-taking. RSI levels on the intraday timeframes are likely screaming overbought, and it would not be unusual to see a retest of the $26 level to confirm it as support. Blindly chasing a 6% gap up without a strategy is how investors get hurt, so watching for consolidation patterns is key. This brings us to a critical segment that every investor needs to understand right now: the short-selling dynamics. SoFi has historically been a battleground stock with significant short interest. When a stock like this rips 6 or 7% in a day without a specific singular news headline, it often reeks of a short squeeze. Short sellers who bet against the company at $24 or $25 are currently underwater. As the price ticks higher, their margin requirements increase, forcing them to make a painful choice: double down and pray for a reversal, or buy back the stock to close their position, which inevitably adds more fuel to the fire. You need to check the borrow fee rates and the shares available to short. If you see the cost to borrow spiking while the stock price rises, it is a clear signal that the shorts are trapped and desperate. In SoFi's case, we have seen coordinated bearish reports in the past questioning their accounting methods or their loan valuations. Today's price action is a direct refutation of those bear theses. However, be aware of the fail-to-deliver data. Sometimes when selling pressure is artificial or when market makers cannot locate shares, you see spikes in FTDs. If this rally is driven by forced covering, it can be explosive, but it can also be volatile. For the retail investor, this means you must be vigilant. Do not just look at the price, look at the flow. Are we seeing large block trades on the bid? That means institutions are supporting the price. Are we seeing put options being bought in bulk? That might mean smart money is hedging against a pullback. Actionable advice here is to monitor the $27 level closely. If we break $27.50 with volume, the next technical resistance might not be until $30. But if we reject hard at $27, the shorts might reload. Do you think the short sellers were right to doubt this company, or are they just pushing fear to protect their positions? I want to hear your take on whether this is a natural rally or a squeeze. Moving beyond the mechanics, let's look at the modern retail sentiment. If you go on platforms like X or Reddit right now, the sentiment is likely euphoric, but also vindicated. There's a sense of "I told you so" among the long-term holders. This social sentiment is actually a leading indicator for volatility. When the crowd is unanimous, the market often likes to humble them. But in this specific instance, the retail crowd has been right about the stickiness of the product. The user-based growth has been undeniable. The debate online is no longer about whether the company is a scam or a failure, but rather about valuation. Is SoFi a bank valued at 2 times book value, or a tech company valued at 10 times sales? That identity crisis is what causes these massive swings. Today the market is voting tech company. Let's zoom out and discuss the macro picture affecting this $26 price tag. The year 2025 has brought a different landscape for fintech. The regulatory environment has become clearer. The uncertainty that clouded crypto and digital banking in previous years has largely dissipated, allowing companies like SoFi to operate with a clearer roadmap. This clarity attracts institutional capital that hates uncertainty. The 67% gain today is likely a function of macro asset allocation, funds moving money out of slow-growth utilities or staples and rotating into high-beta growth names as they chase performance into the year-end. SoFi, being a high-beta stock, benefits disproportionately from this risk-on environment. We also need to consider the competitive moat. Most neobanks offer a great interface, but terrible unit economics. They lose money on every customer. SoFi's approach of securing a bank charter was the pivotal moment that separated them from the pack. It allowed them to hold deposits, use those cheap deposits to fund their loans, and keep the net interest margin for themselves rather than paying a partner bank. That margin expansion is what's driving the earnings per share growth that justifies a $26 stock price. When you look at the chart, you are seeing the visual representation of margin expansion. Furthermore, looking at the 52-week high of $32.73 shown in the data, we can see that despite today's rally, we are still below the absolute peaks. This suggests there is still room to run before we hit major overhead supply.